Our panel topic, pros and cons, deal by deal versus fund structure versus joint venture. So obviously we're trying to get at the decision-making process on deal decisions, and I think we have the right panel for that. Adam Nealick, who is the Director of Investor Relations at Henley, this is a private equity real estate firm, so he is using their own capital plus raising additional capital, so he has one viewpoint. We have Joel Glatcher, who's the CIO of the Glatcher Family Office, so he is the type of person that Adam may look and to seek to invest in various deals, and he has to make his own decisions with the family office. And then lastly, Chris Damian will give us the banking perspective as how they look at a transaction, either differently or the same, depending on who the borrower is, what the relationship with that borrower is, and how they view that structure, whether it's a one-off deal, whether they're looking to lend into a fund or a JV. And I guess with that, maybe I'll start with Adam on what's hot right now, what are you looking at, and then maybe we'll take each one of you, what you're looking at, what's interesting you the most, and what you view as the key driver or key asset class and how it interplays with how you look at the deal.
Sure, thanks. Again, I'm Adam Nealick from Henley. We are a private equity real estate firm that does investing on a deal-by-deal basis. So we are either a sole GP or a co-GP on all of our deals. We were started in the UK in 2006, and our US office was opened in 2016. So to answer that question, and the reason I give that background is because we're deal-by-deal on a co-GP basis, and we have no fund structure, we're not beholden to any terms or verticals in terms of strategies, sub-strategies, or what have you in the real estate space. So we will look at anything in the real estate or real estate-like vertical. There were some panels earlier talking about what you liked in real estate. I would argue there's no real bad real estate plays, there's just a lot of bad real estate deals. So a lot of risk mitigation can actually be captured by doing the right type of deal. That being said, if we have to put broad strokes on it, some of the areas that we actually still find value is C2B multifamily conversions, workforce housing. I'm sure there's some opinions in the room on whether or not that strategy has run its course. But we heard from another panel talking about the operating improvements that you can do. So this isn't just buying for the cap rate compression and looking to find essentially a seller that's willing to pay a higher price than you. This is going in and seeing how is this asset been mismanaged? And we're still seeing a lot of single manager property managers in the C2B multifamily space. That's one area. Another area that most people generally don't think about, but I do, especially living in Hoboken, is the car wash space. So we've actually started looking at car washes as an investment where you can actually buy the underlying real estate. So you have traditional in-bay, touchless, automatic car washes that take anywhere from 5 to 8 minutes. You can go to a elevator or escalator type tunnel where your car gets on and gets pulled through, similar to like what you would see at the airport. You can cut down the amount of time it takes by about 75%. You increase your throughput, high margin, high cash business. There's a lot of private equity firms that are looking at a roll-up type strategy, similar to manufactured housing, self-storage, car washes. I never thought they were this exciting, but there seems to be a lot of eyes in this space. So just a unique deal, an area that we're interested in.
So, all right, so but before we leave you, so you've chosen as a company to have a certain co-GP or a certain strategy. What led you to say this is the best structure for us and what its advantages are?
Yeah, so for us, the co-GP, when we do it on a co-GP basis, we're looking for somebody who can bring expertise that we don't have. So Henley has traditionally been a real estate company. I'll be the first to admit we don't really know anything about running and operating a car wash. So what we did is we brought in a partner, split the economics with them, who actually has the operating prowess in the local markets that we're doing. So now you say we have the real estate expertise, can manage that, whether it's monetizing the underlying real estate, sale-leaseback transactions. However, we'll give away half the economics to make sure we're getting the best operators. And again, goes back to a first point, creating the right structure to get your returns.
Terrific. So Joe, let me go to you. Are you willing to give up your family's money control to someone like Adam and his company, or as a traditional family office, is the reason you are where you are as a family office because you want ultimate control over the decision making on your real estate asset?
Well, I don't know Adam well enough to answer the first part of that question. He seems like a nice guy. I will say that as a family office, we are paid to find people a lot smarter than we are. And that means giving up control. That doesn't mean we always give up control, but I think it's not even a necessary evil. It's like there are great people out there doing great things. I'm a bit of an odd duck because I'm just not a real estate guy. We look at everything from, typical hedge funds to real estate to carbon credits to cryptocurrency. It doesn't matter. We'll look at it. And so with respect to all of those areas, there's no way, no matter how many IQ points I might have, I could ever be an expert at a tenth of those things. So I think many good family offices and sophisticated family offices make a very concerted effort to scan the world to find not only great opportunities, but great operators.
Now, on the deal by deal versus a fund versus a JV, is there any key
Right.
drivers? Is it certain
Yes.
asset classes? I might do one-offs, but I won't. And other ones, if I'm going to involve
Well-
in, say, car washes, I don't want to hear about them until you've got 50 of them that I can invest in as a fund, for example.
Yeah, as a family office, I think it always comes down to a couple of issues. One is conflicts of interest. There are times when a fund structure creates conflicts, whereas a deal by deal may not, especially in the PE world or the VC world.
You mean,
And they're all,
can you flesh that out a little? What's that?
yeah, so I mean, there are lots of times in a PE fund, it gets towards the end of the life, they want to sell something or they make decisions in order to raise their next fund. That's very common. They're being rational. They're not being dishonest. It's just a conflict that comes with the turf. I will say in the realm of private equity investing, whether that's early or later stage, the world has changed a lot since I started doing this about 20 years ago, because now there are tons of co-investments that come to families, not just me, to any family. And so, we're constantly faced with the decision, we're giving up the benefit of netting by going deal by deal, right? That makes sense? And that's a huge benefit to us in a fund structure, the netting. I assume people understand that.
Yeah, you flesh it out for a second.
I mean, basically, if you have an asset, if you have a fund, I should say, and you invest in two private equity deals, and one goes up by a lot, one goes down by a lot, you're net zero, flat. You didn't make any money, and you didn't pay any fees. If I invested in each of those individually, I made a lot on the first one, and I paid a lot in incentive. On the second one, I lost a lot. I didn't get the benefit, that negative incentive, so I am much worse off having invested in deal by deal, just economically speaking. That said, as a family, there's a lot of, I would say, psychological benefit we get from being able to see a deal, to underwrite a deal, to follow a deal, as opposed to giving somebody money for 5 or 10 or increasingly 13 years and hoping it goes well. And it's very hard to account for all the different fees and expenses that run through a fund. And so that's another challenge we have as a family. So there are lots of different issues that go into it, but incentives and conflicts, and just the fact that we can see so many individual deals has led us to do a little more on the deal-by-deal side, especially in the more private areas. In liquid hedge funds, we're much more likely to go into fund structures.
All right. So let's bring Chris in here a little bit. Okay, so you're hearing this, Chris, and they're coming to you, someone's coming to you for some financing. You're head of a private bank group for the bank, so you're used to relationship banking. Tell me the thought process when the relationship walks in the door. What are you most concerned about on a deal, one-off basis versus a fund or a JV structure? Give us some what goes through your thought process.
So we're City National. We're the City National of Florida. We're the third largest bank in Florida, and we've grown over the last few years from $8 billion to $14 billion due to a couple acquisitions and, of course, organic growth, just because Florida's had so much growth. And what we've realized is now that we're a bigger bank, we have to explore different alternatives of just traditionally doing deals with our clients, which would be a deal-by-deal structure to folks in the Florida community. And what's happened, if we'd have looked at our portfolio 3-4 years ago, we'd probably say there'd be virtually no funds in there, lending to any funds. But when you get to a size like ours, and with the migration of capital coming from New York into Florida, we're now at the point where we continuously are lending into the funds. And again, we're looking at at each fund, we're looking at each deal. So if the fund had a goal to put out 10 deals in the next 5 years, we'll underwrite each deal as it is. And one of the things we do like about the fund structure is the folks that we're lending to are much more sophisticated. The reporting is much better. There's a full-time CFO in there that we can constantly communicate with. And compared to the folks that we built our company on, not that there's anything wrong with that, because we're a relationship bank and we'll continue to work with them, but as they do it, they're doing deal by deal, and we're basically looking at them a lot more on the recourse side. So what's changed is on the fund structure is, we don't get the recourse there, but generally they're much more, in our opinion, they're more conservative deals. So we like that. If it's a startup fund, or if it's a family or a group that owns a very large percentage of it, then we'll start looking at the recourse into it. If it's a relatively new, or the deal itself has a little bit more risk. But now so in sum, we like the fund business, and we like lending into the funds.
So we can go in order here. You all have different viewpoints, so tell me about the diligence that you need to do. You're risking having a co-GP. You're risking your family money on a third
I'm risking
party.
a terrible Thanksgiving dinner.
Right.
Yeah.
And you're risking the bank's money. So I guess give me a sense of the diligence process on a one-off deal and versus a fund deal.
Sure, and I think at least for us, the way that we think about it is that on a deal-by-deal basis, if somebody's not committed to programmatic investing to individual deals, then yes, they have a lot more risk in one individual deals, as we highlighted. Most of our investors are ultra-high net worth, family office, RIA, and they are putting together a portfolio of 10 to 20 deals, and that's how they get inherent diversification. That is one of the large benefits of a fund. That being said, to answer your question more directly, on a deal-by-deal basis, I think you do need to be a lot more conservative in terms of who the sponsor is and who your partner is. And you need to be comfortable that, I like to say, don't follow the shiny object. We heard, I think, a crowdfunding story earlier, that if you're just looking for the highest returns, you're following the shiny object. You actually know who the analyst is underwriting the deals. Do you know who your sponsor is? Do you know somebody like me, who's going to be your investor relations person that's picking up the phone? I think that matters a lot more to your personal due diligence when you're doing deal by deal than fund structure, which can inherently buffer some of the risks, but at the same time, it loosens your individual control as an investor. So due diligence
Is this a
higher.
gut due diligence, or is it programmatic? Do you have steps where you'll do it Dun & Bradstreet, so to speak, or your background check? Or
Yeah, most of our investors will do due diligence on Henley as a firm. They want to know who the CIO is, how long we've been in business, what our track record is, underwriting pro formas versus realized gains, and then once you get comfortable with the shop that it's a real sponsor, institutional quality sponsor, then the deal level due diligence, I think, is a notch below that, because you have institutional quality reputation behind you.
Joe, walk us through your diligence process.
Yeah, I've sort of, my process has definitely changed over time. I used to run research at a couple of large fund-to-funds, and in my capacity as a director of research, our job was just to write research memos. That's what we did. We would source funds, and we would write memos. And back in the late 90s, when I started, our memos were about 2 to 3 pages long, and they were okay and not particularly good. And by 2012 or 13, if you go to any institutional allocator like that, they're writing 20 to 30 page memos. And so that's what I was doing there. When I left the institutional side to work at our family, I quickly sort of cut down on the 30 pages, because as a fund-of-funds investor, and whether that's a real estate fund-of-funds or a hedge fund fund-of-funds, like, your goal is to cover your ass. Can I say that here?
I think so.
Okay.
We're offline.
Right? And so, like, you just have to have thought, so if a consultant comes in, an investor comes in, they said, what about X? You say, oh, see page 27. Like, we did that. Whether or not it's relevant at all to the actual investment case. And so when you're a family and you don't have the resources of a large institution, you focus on what's important. And so if I'm investing in a long-short equity fund that trades S&P 500 stocks, I'm not going to write, do 4 pages of liquidity analysis. I know it's pretty liquid. Could there be a problem? Yes, but it's all cost benefit. Like every time I spend 3 hours researching something, I'm not doing something else. And so that's what we're constantly fighting. And so what we do today is we basically write 1 to 2 page memos, and we only write up what we think is critical to understand, and no more, ever.
Okay. So, Chris, from your standpoint, you have 20-year relationship with a high net worth client. They come in, they say, I got this great JV that I want to do, and I want you to fund our deal. And my partner is Mr. X. And you say, I don't know anything about Mr. X. Matter of fact, I haven't heard anything good about Mr. X. Walk us through the diligence for the bank, for example, and how it might negatively impact your view of the transaction for a good client.
Well, first, my returns are a lot lower than my partners up here, their returns. So we're if we're looking at that 60-65%. So the challenge when a borrower's coming in with a bank is, of course, everybody wants a higher LTV so they can increase their yield or put less of their cash down. And so that's where we look at who the joint venture is with. And generally what we're seeing in Florida is the local folks that have been developing in Florida for a long time, and they want to start doing bigger things. That's when they start partnering up with the funds coming in from New York and Boston, Chicago. And that's where we get even more comfortable. So we look at it a combination of, hey, we're going to get the backing and the diligence and the reporting and the compliance of the fund paired with a local expert in the market. And when we see that combination, that's where we can start squeezing out. And you always hear when you're talking to your bank, you'll always hear them say, well, our policy says this, and let's see where we can work within our policy. And when you get that combination of the fund plus the local JV, you get that combination, that's when the LTV can start creeping up a little higher for them, because that's mitigating. We think that combination is a mitigant of risk. Thus, we can justify going a little bit higher on the LTV. So
Let me. So it goes more to, in your mind, more to LTV than rate, for example?
well, it's a function. Rate's going to be a function of the risk, but
Right.
but again, the LTV is first, there's a competitive driver in this
Sure.
situation, but the LTV is going to be a function of how much we like the deal itself combined with the operators in it. And again, that combination of, like I said when I started, is I like the fund, working with the funds because of all of the diligence I get and all of the compliance and all of the reporting. And if I combine it with this, a local developer that knows the market really well, that's had so much success, that's when we can start increasing the LTVs. Is because, again, what everybody's hearing out, I keep listening to everybody talk about where we are in the cycle, and, the word we're always using, and I don't think I'm unique, is cautiously optimistic, is we don't know if this is if we're in the 8th inning and we're going to go to a 15-inning run. So what we're doing right now is we're looking at certain places where we might be overweighted, but at the same time, we're dropping LTVs in certain places, but increasing in other places. So again, it's a deal. We look at each deal.
So let me stay with you and we'll work our way back. So let's deal one-offs, JVs versus fund, asset classes. Are there certain asset classes you'd rather not see as one-offs and you'd much rather see them in a fund? For example, you touched on, self-storage obviously loves portfolio, right? Multifamily, the bigger the portfolio, the better the cap rate on the sell side. So give me a sense of asset classes and where you would rather see a portfolio or a larger fund deal versus a one-off, and maybe also if there are price points where, for all three of you, both asset class and price points where you would favor one structure over another, or maybe not.
Yeah, well, mine's pretty simple. I mean, I'm going to look at the deal and the operators and that combination. So there's not one thing that I don't like or I do like more than others. I'll go there, if there were industries, there are particular industries.
But I mean, is there a sweet spot loan above, below, what you prefer or not prefer?
So look, for our company, again, our goal is to kind of find a niche where we can compete with the bigger banks. So we're looking at the $5 to $50 million on the commercial real estate side, and the $3 to $30 million on the corporate deals, on the asset-based lendings, and even some cash flow deals. We'll, again, if I'm lending into a private equity fund that's buying operating companies, I'm gonna look at a little lower leverage, because again, my returns aren't that high, so I'm not gonna go over 3 times probably on the leverage side. So, and again, it's a deal by deal situation.
Okay. Joel, what about you? What do you want to stay away from or steer towards based on the structure?
Well, I would describe myself as cautiously pessimistic with respect to the real estate cycle, but, and I wanted to mention that I like Florida a lot, and I like vacationing there, right? So I would say of all the deals we've done in real estate, and we're not real estate focused at all, I would say 80% have been deal by deal, and that's primarily because we like to find a unique little niche opportunity, and those are often smaller deals that don't necessitate a deal structure. We've invested in self-storage. We've invested in a couple of different funds that I think are somewhat unique, but by and large, it's all deal by deal with what we've done.
So Adam, what do you say?
So I'll give a long-winded non-answer as the answer, because I come from MSIM, which is Morgan Stanley Investment Management, where all I sold were commingled funds, and now Henley is a deal-by-deal shop. So hopefully this is coming from a place of honesty, but I don't know if there is a size range. So for instance, MSIM had funds that would focus on the lower middle markets, and whether it's private equity, private credit, energy infrastructure, value-add real estate, you name it, you can write $5 to $15 million check sizes, which is what MSIM did, or you can be Blackstone and you can write billion-dollar check sizes. I don't know if, depending on what your needs are as a client, there's no right or wrong answer for that. One thing, maybe if you want to break it down, compare and contrast, most private equity managers or portfolio managers, if they're being honest with you, will tell you that the main driver of their performance comes from seeing the best deal flow and access to the best deals. That's usually the #1 predictor of outperformance and being first quartile. Blackstone's going to have that based on their size. A smaller manager might not, but a smaller manager might be able to do a $1 to $2 million EBITDA company that Blackstone just can't do based on their size. So there's no easy answer to that. A visual representation I always like is when you go to the supermarket, sometimes they have those prefab carts. They're like $200 and they have everything in there. That could be your commingled fund. 90% of what you want and need is going to be in there. And say you go to, I'm an A&P guy, I live in Hoboken, there's one around the corner. You know that A&P, it's a quality shop, they've put it together. It probably has most of what I need, but not all of what I need, right? That's a pretty good symbol for a fund. Deal by deal is I have to walk around the supermarket and pick out everything I want. So it goes actually to Joel's point earlier, where's your time best spent? That's what you really have to decide as an allocator, and that'll drive your answer, I think.
I just want to add, it just occurred to me that I was having lunch yesterday with somebody, we were talking about a related issue, because they were trying to decide whether they wanted to raise a fund or go deal by deal. This is a bank claim group, not related to real estate necessarily. But I was telling them that, interestingly, I think their ability to market themselves increases if they go deal by deal. Even though they would probably do far fewer deals. Because inevitably, if I talk to a fund and they say, great news, we did 20 deals, here are 4 of them that we're going to point out, and I'm always thinking, well, what about the other 16? Right? I want to hear about those. If someone does a deal by deal and they say, listen, we've done 3 deals, like, all right, let's see everything you've done. And I mean, it's a little counterintuitive, but I think it actually helps them from a marketing perspective. I don't know if that's relevant to anybody here, but I do think that.
No, it's certainly an interesting, it's what you not knowing, I don't know what I don't know, so to speak, right? You don't know how many other deals they're not telling you about. So let me ask about what you're seeing in the market as far as investment hold periods. Have things changed from a family office or a bank or from your perspective? do people want to get in and out of deals faster? Is it 5, is it 7 years? What's the exit strategy when they want to get liquid?
The target for our firm, at least, is a 3 to 5 year hold on our individual deals, which differs. Traditional funds are on the private equity real estate space. There's private equity usually 8 to 10, even 12 years plus 1 or up to 3 year extensions. Again, it really comes down to the client you're looking at. So us, high net worth RA family office, like a 3 to 5 year hold. You can talk to a pension fund that would love to tie their money up for 25 years if they could.
Is that just historical, or is there magic to the 3 to 5 year window?
So 3 to 5 year, we do opportunistic value add in the real estate space. So usually you have 1 to 2 years to get into your CapEx, 1 to 2 years to clean it up, and then hopefully 1 to 2 years you're looking to sell. And that really gets you to a 3 to 6. That's, your 80-20 rule. 80% of the deals fall in that window. We did some that were shorter. You'll have some inevitably that run into problems and take longer. And that's the same whether you're doing a deal by deal basis or fund basis. You always have the ones that are your home runs, and you wish you could do 100 of them, and then they're the ones your problem childs and your workouts that take longer to monetize.
Joe?
Yeah, I would say as many folks have crept out along the risk curve, their tolerance for duration has increased from whatever it was to whatever it was plus something. That's just across the
I'm gonna
board.
quote
That's
you on
what I
that.
see.
Give us the bank side.
Well, we certainly, again, if we're looking on a deal by deal and that operator, we're seeing it all. We're seeing people that are going in and speculating, and we know that. We like retail. Everybody says retail is a dirty word,
That's
but
my next question.
yeah. So we think there's been a lot of shakeout in retail already. We like the people. That's when we go back to the smaller on-site folks that they're going to recap the properties. That's when it starts going into our private bank, because now we're looking at somebody with, or if it's a fund, somebody that has the cash and the time and the stability to outlast the lease-up period. They're buying a distressed retail center, and they have to convert it over into the new services that are now taking retail, and that's popular now. Everybody's converted to schools and other things in the malls, and there's more hair shops and
Gyms everywhere.
gyms, and in
America's
Palm
gonna
Beach
get
and Florida, of
50%
course, the massage parlors that some New England fans may visit, but.
Well, let me drill down a little on that. So there's retail and then there's retail, right? We've got everything from franchise standalones to one-offs to strip centers to the bigger malls with acres of empty parking lots. So I guess we'll start with you and go this way. What do you mean when you say retail is still okay, and what are you avoiding like the plague?
Again, risk, what we're doing is, again, my returns aren't as high, and then there's always a deal to be made.
So I got a Blockbuster, you're going to finance
Well,
that? No.
Well, I'm going to finance the person that's going to buy the property and get them
Okay,
out
fair enough.
and go. So, look, again, if my lending limit, as I said, is going to be no more than 50 million, there's a certain size that I can do. I can't do the giant malls, but the corner strip malls we like. We'll do that to the right people and the right operators, people that have a track record of turning these things around and leasing it up. So we're in there. There's not anything that
Is that more of the pros, or is that more of the family office, your relationships that are coming to you that have the kind of wherewithal, the ability to turn around a strip?
That's purely operator driven, and that's where the joint venture would come in, because the operator that's done this a number of times will come in and say, hey, I've got this, potentially maybe it's a bigger piece, and he'll say, well, I'm going to joint venture with this family office. So now I see that there's capital behind the person. They've got their own money into it, but I've got the family office. And again, on my risk profile, I'm at 65% loan to value there. So it goes back to what I said at the beginning. I've got the capital and the funds in the JV behind me with the local operator. So that combination we love that combination.
Okay, true. So Joe, retail versus retail, what do you like, what do you not?
I really don't have anything to add on that, honestly.
Okay. Adam?
I don't know if anyone's a fan of CB Insights, but I think they coined the phrase the retail apocalypse. And I feel like I'm going to sound like a broken horse or a dead horse up here, but it really is the deal that matters. Specifically retail, if you bifurcate it out, if you go to Short Hills, if anyone's from this area and you're ultra premium, those malls have held up well. So now we're just talking about the sub-segment of malls and shopping malls. If you go down to the lower tier and you look at the Dollar Generals, they've all done really well. It's been the middle part of the retail that hasn't done well. So again, you can do really well in those areas. And even in the middle one, we're seeing now some operators are structuring deals where it's not traditional leases, but it might be a traditional lease where they get 3% of the revenues off the top. And that's a way to buffer your downside. And again, the thinking there is there's a deal to be made if it's the right deal that can mitigate your downside risk. So it's hard to put all these in a category. Hopefully the one thing that people are seeing me resonate again and again is it makes sense to do your due diligence on who you're working with and what your downside protection is, because that can really, maybe that mitigates your home runs, but when times get tough and you want to pick up the phone and know you're actually in bed with a partner, that's where it's going to matter, right?
Do you like triple net either on a one-off or on a fund basis? Or?
So we'll look at it as a driver of improved returns on our deal-by-deal basis. So normally if we can underwrite without actually having to do any triple net lease or sale leaseback, as we look at that in kind of the same vertical as opportunity zones, which was another topic, don't underwrite those. So depending on what inning you think we're in, don't use non-operational improvements to increase your returns. And if there are things you can do to go from a 20% IRR to a low 20s or a mid 20s, then that's how you can get outsized returns. But don't do that as your underwriting thesis, because I think that's what hurts you on a prolonged downturn.
Are any of you still in lending or involved or interested in the construction space, or is it all just stabilized at this point? We'll start with the bank. Florida's still booming, so.
Again, as you said, Florida is booming, and we love that space because what's happening is the agencies or the life companies and all of them are going to end up taking us out on the bigger deals. So they don't do construction. That's where I can have a niche. So we'll do the vertical part of it. They end up taking me out because by that time they're getting Fannie Mae financing at 80% non-recourse. So for all construction, we're looking for a guarantee on the, and when we come to the fund, we're looking for some backing.
Typical suite of expected guarantees on a construction loan, basically?
Yeah.
Carry completion,
Yeah.
et cetera? Okay.
Until then. So we like construction and we're going to continue to, and there's look, we're not doing high-end condos in Miami right now. I mean, we've seen that video, so we've kind of cut that off.
So you guys you willing to take the risk on construction for the return, or is it you'd rather not? Either of you.
We don't do a lot of, we looked at a bunch of ground-up projects. It's very hard for us to get, typically an equity investor, to get comfortable with the assumptions. Where we've had a little more success is on either, as a senior creditor or even preferred equity in one case. But most of what we do is not construction.
Madam?
We've done one deal in the space, but it's not a core thesis, so.
So let's talk about what you've done, if you have or haven't, in Florida. I mean, there's a lot that's been said, why Miami, et cetera, going right. Florida's not alone, but it's certainly a leader in the demographics shift, right? The population shift, the industry shift, the focus shift to Latin America, et cetera. Joel, I think we talked beforehand, and you said it was a place at one time that you weren't comfortable in.
Yeah.
But it's matured, more sophisticated players.
Yeah,
there, so tell us
yeah. I mean, I'll repeat this somewhat cautiously. That as an allocator, we used to not deal with funds based in Florida because there were so many poor actors that had come out of the state, and this was in the sort of the 2005, 6, 7 timeframe. And today, I would say that's largely changed because we've seen so many well-respected investors move down there for all sorts of reasons, primarily tax. But it's changed. It used to be a small community, and there are a lot of bad apples among that small community. And now it's changing, so we do actively look in Florida. My family lives in Florida. So I don't think we have any investments today in Florida, but we're going to sure look for one after today.
Better. Adam, same question. The evolution of the maturity of the Florida market.
So interesting, we're raising for hospitality down in Florida. So we do actually have 4 hospitality assets, actually in Miami, 2 in South Beach, which we like. The population growth, the trends are favorable, and we had another presentation earlier. Most of ours are sub 100 keys, and we're looking at lifestyle brands. So there are ways you can actually, again, drive the operational expertise on those, and we're working with a joint venture partner who is replacing the OTAs with actually built-in software. So it's ways that you can more professionalize the asset, but again, it's controllable when you're under 100 keys. So we like the area. Even if you think there's a slowdown, if the dollar weakens, you traditionally see Florida as a place where you're actually going to get a lot of Latin American and European visitors who want to come visit, which is just positive demographics. So, slowdown could be good for some assets, could be good for others, depending on your view. But we're generally positive on Florida, on Miami specifically, and hospitality. We have assets.
Terrific. Last question with the panel, and then we'll go to some question and answer for the group. So I'll throw this out there. It was touched on in some earlier panels of the role of technology, whether it's AI or blockchain, tokenization, et cetera. Any impact on you guys yet as far as decision-making, or is it still a little bit too early for the space?
We're interviewing firms are coming in every week with different solutions, everything from, I don't know if you want to call this AI, but everything from doing underwriting over in offshore in India to computer programs that will make our underwriting even more sophisticated. So I started out when I was doing spreadsheets by hand, so that'll tell you how far it's gone. But I haven't seen it yet where it's dramatic. And we're slow movers. Remember, bankers, we're always the last to adopt. We're slow movers. We have short memories, all of those things. So we're doing a wait and see, but we're interviewing and spending a lot of money through this process.
Okay. Cool.
I invested with my first Florida company 6 days ago. I forgot.
Excellent.
Yeah, sorry. I just thought I would add that.
Would you buy into a building, based on tokenization,
No.
as the liquidity, as the exit?
No, not today. I mean, I invest in plenty of companies in the blockchain space and the AI space, but tokenization, which I think will one day be a thing, I think has a pretty long way to go for a whole bunch of reasons.
Hearing anybody looking for that kind of technology, exits, et cetera, for liquidity purposes or for other ones?
From our perspective, no. Where I would love to see technology is from an investor standpoint. That dealing with alternatives and private equity is a complete pain for investors. So if anyone can actually figure out the onboarding, the paperwork, the reporting, and clean that up, that's where I'd love to see technology. There's a lot of places working on it, but the qualified purchaser, the accredited investor, qualifications, and all the hoops you have to jump through with KYC, if we could get a better solution for clients, I think it would actually help everybody, probably in this room in some form or fashion.
All right, so it sounds like it hasn't really impacted your decision-making process yet. So with that, we'll open it up to any questions or comments from the audience.